Welcome to the short financial and economic overview. It was written long before the recent market turmoil. This is not financial advice, just a sharing of research from public sources. The links to the sources are in the window below, so you can check them out for yourself for your own research. We're going to scroll down the chart. This is a visualization of all the world's money and markets. And what we see is that each square is worth $100 billion. Silver's tiny, cryptocurrency is tiny. There are only three things on this chart not related to debt: silver, gold, and cryptocurrencies. Consider how small they are compared to everything else. Debt is credit, and we have a credit and debt crisis growing far faster than the economy. They call debt and money production QE, quantitative easing. It's all the same thing. Half the US economy already goes on paying interest. In 2001, a few billion were used to stimulate the failing US economy. But in 2008, over 7 trillion was needed. That's 7 million. The Federal Reserve began intervening in the bank sector last September 2019, and it's now producing new QE, or debt, at a higher rate than at the height of the 2007 financial crisis. On March the 12th, 2020, it announced an extra 4 trillion to support the markets. That's 4 million, 4 times the US annual deficit. Yet the real crisis has only just started. Take a look at the bottom here. Bitcoin compared to everything else. So, the debt crisis indicates that central banks are going to inflate away unpayable debt, and a debt spiral is exponential. At the moment, anywhere between 14 and 39% of S&P 1,500 companies are zombie companies. They can't even service the interest on their debt, and it's just adding up instead of being paid. The result of creating more debt to support a financial system imploding with debt is that the cycle gets bigger each time, and bubbles happen, first in the stock market and housing. To see how overpriced the markets are, look at this. And observe that it took until 2017 to recover from the market crash in the year 2000. We're now having a look at the world's best performing assets. Gold and silver since the year 2000 have far outperformed the stock market. This is Bitcoin for the last 10 years. It's completely thrashed everything else. Bitcoin is established, but only in the sense that everyone has heard of it. But as the first link showed, all the world's money and markets, it's not deeply financially established. So that means there's lots of room for growth. And it should also be noted that over the last 10 years, Bitcoin has been declared dead over 250 times. Let's look at Bitcoin a bit more closely. Here's the price chart in the green and the blue. And as you see, it breached $20,000 in December 2017. We should also consider that Bitcoin has a 3-year cycle, so powerful we can't even see it on the chart for 2014, 2015 and 2016. So at March 2020, we're only 15 months into a 3-year cycle. No one knows where it will peak this time, but we do know the chart patterns say it will be a lot higher than here. But this is not just about chart patterns and cycles. In 2018, 15% of banks and financial institutions used blockchain technology, Bitcoin technology. In 2019, 84% of them reported that they will be using the technology within 18 months. And this is one reason why the technology has been described as more important than the internet by Forbes and Bloomberg magazines. We're now going to look at the technology adoption cycle. Note where we are in the technology adoption cycle for Bitcoin, very early. Ask yourself, how many people own Bitcoin versus how many people have bank accounts? We're very early. I think we're about here. Debt is the real issue, and this is the US debt clock. The debt clock, however, is only telling part of the story. The US figures are for a total of between 220 trillion and 260 trillion in debt, because the figures not shown here are personal debt and corporate debt. Let's now have a look at the unfunded liabilities here in the bottom right. This is what the government's guaranteed to pay. Social Security, Medicare, The unfunded liabilities equal $397,000 per citizen. That's every retiree, every man, woman, child and baby in the US. It's more than double that for every taxpayer. And here's the evidence. The true size of the US national debt, including unfunded liabilities, corporate debt and personal debt, is $222 trillion. That's at least $222 million. The US population is 329 million. So this is $800,000 for every man, woman and child in the US. It's more than double that for every taxpayer. Now, there are only 6 million millionaires in the US, and 40% of the US population doesn't have $500 saved for emergencies. So how is the debt going to be paid? Easy. Governments and central banks are going to inflate away the debt. They've already told us this. But in the process, they're going to make their countries and millions of people bankrupt, because it's not possible any other way. Here's another issue. The purchasing power of the US dollar has already declined 96+% in the last 100 years. And if exponentially more and more currency or debt is created to deal with the debt problem, eventually it has to cause inflation. In fact, the inflation already happened in most markets, apart from gold, silver and cryptocurrency. Take a look at the stock markets and property prices for yourself. Gold, silver and crypto have been held down because they make fiat currencies look bad. But the lid will fly off when the markets drop and money runs to safety. Then, high street inflation will be unleashed through rapidly rising retail prices, and that will lead to a loss of confidence in the money system itself. The signs are already there. And on average, fiat currencies, which have been introduced hundreds or thousands of times over thousands of years, only last 27 years. The historical failure rate is 100%. And this is why next time the bailout will be tens or hundreds of trillions of dollars, and that will cause a market shock, a massive increase in government debt, the credibility of the system will collapse, and this time central banks can't use their other tool, cutting interest rates. They can only go negative, which will penalise savers. And that will cause a flight for them to save what they have. If you were a multimillionaire, would you be keeping your wealth in the bank, knowing instead of earning interest, you will actually be guaranteed to lose money doing it? Or it could even be subject to a bail-in, seized and swapped for the worthless shares of the bank, as they did in Cyprus a few years ago. So even if a few percent of major hedge funds, pension funds or the world's rich move some of their money into gold, silver and crypto, it'll be like a swimming pool trying to fit into a teacup. And those items will explode in value. And at the same time, other things will fall off a cliff. This is what always happens when market shocks occur. It's another pattern. All we need for hyperinflation is for people to lose faith in the currency itself. And when it's not even safe in the banks due to negative interest rates and bail-ins, they will spend it on real things to try to preserve value. To put this into proportion, to get rid of the $49 trillion debt of Deutsche Bank, that's $49 million, it implies creating money worth 20 times the GDP of Germany, 8 times the GDP of Europe. But the Greeks, Portuguese, Italians, Irish and Spanish, also in the Eurozone, have never recovered from 2008. So it's going to be paid by destroying the value of the debt, by destroying the value of the currency itself. So what kind of crash are we looking at? Charles Nenner, former head of forecasting for Goldman Sachs, is saying there will be an 85% drop in the stock market and housing over the next 2 to 4 years. Things have already gone exponential, with the debt rising exponentially and the value of the money falling exponentially. When gold goes up, and in 2019 central banks were already buying more gold than they were in the previous 50 years, it indicates that the big money has already begun to run to safety. Silver will go up more than gold. There'll be a lag though. Gold will move first, and many more people can afford an ounce of silver compared to gold, so it's going to be their only option. Even better, cryptocurrency is more or less infinitely divisible. You can buy $1 worth or 50 cents worth. And it's an even smaller market than gold. So like Venezuela and Turkey, we will see a flight to safety there. because there have already been silver shortages last year in several countries. You just couldn't get hold of it at one stage in Australia, Sweden, and even from the US Mint. So now let's look at what some other cryptocurrencies were doing. When Bitcoin went up last time, some other cryptocurrencies went up much, much more. And when we remember all the world's money and markets chart, we can see why. Because if Bitcoin is 60% of the overall cryptocurrency market, even a top 10 coin could be worth less than 1% of Bitcoin's value. And if massive institutional money is coming, then if Bitcoin goes up 10 times, that coin could easily go up 100 times or 1,000 times. In fact, the last time altcoin season happened in 2016, we saw gains like these: 1,790 times, 2,831 times, 3,505 times, 4,144 times, 5,397 times, 7,978 times, 10,018 times, and 20,899 times. This time, the gains from altcoin season will be bigger because it's a function of mathematics. There are more people involved, more institutions, and more money, more big money getting involved. The big money is the smart money and it moves first. Remember the volume under the Bitcoin chart? They try to find the best value and the biggest returns. So it's important to understand that it is better to be in too early rather than too late. And finally, bear in mind that all assets tend to fall in the immediate aftermath of a crash, temporarily. Gold, silver, and cryptocurrencies will have to be sold by traders to cover their margin call losses on their share trading. Then they will skyrocket, or even be unavailable. In all likelihood, there will be a lag also after the devaluation, and probably a second lag, as gold will take off first and then silver. Remember, this is not financial advice, but I hope I've encouraged you to look more deeply and do your own research. If you thought the presentation was interesting, you may be interested in the longer version. Thanks for watching.